Everyone, I welcome you once again to our series of this lectures on the topic which is revenue. Friends, one of the considerations, one of the important elements in recognition of revenue is to understand how should we be and when should we be and how much should we be recognizing revenue in our books. Okay, so what we are saying is that if let's say you are going to let's say a seller, at what time should he book a revenue? Okay, and how much should he be booking it is something which is an important consideration of this topic again. All right, so if I say that I'm buying some goods, it's quite straightforward, it's quite logical to assume that the moment the control of the goods comes to me, the seller should recognize sale in his books. It could be another way of looking at it, that if somebody is providing a service, or let's say somebody is constructing an asset for me, so normally that recognition of revenue should happen over a period of time. Okay, broadly the principles have not changed in this standard as well. It remains pretty much on the similar lines, but the standard has been a bit more specific on explaining when should that sale be recognized at a point in time and when should a sale be recognized over a period of time. All right, what we are saying here is we look at this context of the performance obligations or the promises which are satisfied over a period of time. If any of these three conditions, there are three conditions given, 1, 2 and 3, any of these conditions getting met would mean that the revenue should be recognized over a period of time. All right, and if none of these conditions are getting met, then it's quite obvious, quite logical to say that the promise is supposed to have been met at a point in time, right? For example, selling goods at a point in time, delivery is complete, sale is recognized, not over a period of time. Okay, so when you look at this particular paragraph of my standard is trying to give me a similar kind of comfort there. It gives me some broader guidelines in terms of what are the scenarios, what are the conditions when I should be recognizing my revenue over a period of time. Okay, we should be remembering something like a percentage of completion. That is something which is the idea of, again, looking at over a period of time. I'm not going to talk about at this point in time whether I'm going to use or what method I'm going to use for that percentage of completion measurement. We are rather talking about under what circumstances should I be using a percentage of completion method. All right, let's have a look at these conditions one by one. The first condition says the consumer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. Okay, now this could be quite straightforward in case of services. Okay, so let us say that you are let's say paying at a gym for 2 years membership. All right, and the membership allows you to use the gym as and when you wish to. Okay, so when I look at this service being available to the member, very clearly the consumer is able to receive and consume the benefits as provided by the entity's performance as the entity performs as well. So that is where you are able to allow that customer to consume those benefits. So any such kind of annual maintenance contracts or AMCs as we call them, any such kind of service related contracts, cleaning services, let's say warranty services and things like that would normally be considered as satisfied over a period of time. Okay, on the other hand, if I say in the similar situation that the membership of such a gym is purely on the model of pay and use. Okay, a very flexible model that you are talking about, that you allow members to come, pay for the usage, maybe on an hourly basis, something like that. This is not something which is arising over a period of time, but it might be considered as a performance obligation or a promise satisfied at a point in time. Okay, so that is how you try to differentiate in terms of how should that revenue be recognized here. All right, so that's the one part. In case of services, just would like to reiterate that normally you see these things being satisfied over a period of time there, and accordingly the revenue recognition would happen also during the period rather than at a point in time. The second one says that the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Okay, an easier example could be, let's say, a construction of an asset. Okay, it could be a ship, it could be an aircraft, it could be a building, it could be a house for that matter, it could be a hospital. Normally such kind of non-current assets would allow creation or enhancement of an asset that is now controlled by the customer. Okay, so what you're looking at, the term control here is precisely talking about that the customer is able to direct the enhancement further or the use of the asset as per his discretion. All right, so when you look at these kind of contracts, these kind of revenue contracts where the entity's performance is creating or enhancing an asset that is controlled by the customer, that would also be taken into the category of, let us say, a performance obligation or a promise satisfied over a period of time. All right, we'll be using some more examples to understand this better, but it would be a good idea to also look at this condition and see to it how does it differ from the second condition there. Okay, it says that, third condition says that the entity's performance does not create an asset with an alternative use to the entity. Here the entity is the seller, of course, and the entity has an enforceable right to payment for performance completed to date. Okay, let's take an example around this and see to it, do we connect with that example entirely or not. Let us say there is a company in the business of making satellites. Okay, so some governments could be the customer for such company, right? So they would instruct what kind of satellite is required to be made, where in orbit it would be launched, and when it would be launched, and lot of considerations would come, right? Let us say that the contract itself specifies that irrespective of the outcome of making of that satellite, okay, the company shall be reimbursed with some profit margin on the costs incurred. All right, so here let's say the satellite completion may itself take around 2.5 years time. All right, but as and when the satellite is getting constructed, the government may say that I don't care how do you make that satellite, and I don't want to really worry about it. I just am looking at, it should be launched successfully. Let's say in the Earth's orbit, or wherever it has to be placed. So when you look at this kind of a condition, the control does not lie with the government here. Okay. But at the same time, in this case, the customer is not getting the benefits of that satellite either. So none of these two conditions are getting satisfied here. But precisely here you're looking at the satellite is very much specific to the government. Right? Here the government, of course, is the customer. The company does not have any other use of this satellite per se. That is something which is very much specific to that government's or the customer's requirement, and at the same time the company can certainly claim charges for whatever work it has done. All right. So when you look at this condition also getting satisfied, we are talking about the use of percentage of completion method, or we may say that performance obligation is assumed to be satisfied over a period of time. All right. As against this, let's take one more example and see to it, are we able to differentiate between these scenarios with something else? Okay, let us say that there is a satellite, but payment will only be done if it is successfully launched. Okay, so in this case, the government does not receive or consume the benefit. The company which is making the satellite, that is not controlled by the government. For that matter, even the company, the seller, does not have any enforceable rights for the work done to date, because the primary condition of payment is only arising if the satellite is successfully launched. Which means what? It safely means that this is a performance obligation satisfied at a point in time. That is, the company which is making this satellite can only recognize the revenue when it has launched that satellite successfully, right? So that is how you try to differentiate. Imagine you are getting into a contract with a building contractor who promises to sell you a house, right? If the contract comes like this, let him complete that particular house, and that is where you would pay him. You will not pay him otherwise. Okay, until then you don't even look into it. How does the house look like, what kind of material is being used, and what kind of furnishing is being done. None of these conditions are getting met, and that is where you look at performance satisfied at a point in time. On the other hand, if I look at it, that you pay something at the starting point, you have to pay something, as and when the progress takes place, the other party can claim, on the cost and charges a margin as well. That is where the third condition may get met. Okay, or let us say on the other hand, while that house is being constructed, you are able to direct it in terms of how the construction should take place, what are the ways in which the finishing should be done, and what kind of material should be used, how would the labor be working on, the different parts of the construction there. So you look at all these things, that is where the second condition might get met. Okay, so broadly what we are saying is, when you look at performance obligations satisfied over a time, that is where you would like to and you are required to use a percentage of completion method, right? What are those methods? How do we calculate? Is a different point altogether, which is beyond the scope of this particular discussion that we're doing today, right? So far so good. Now we look at later on in terms of what are the indicators when we say that actually speaking performance obligation is satisfied at a point in time, right? So we'll be talking about that as well in the next series of discussions. Till then, good so far. Thank you very much. Have a good day and take care.